Get started. Hi, everybody. We're going to talk about some really exciting stuff, taxes. As you know, the legislation for taxes was signed into law on July 4th. It's officially called the One Big Beautiful Bill. Now that it's an act, I'm calling it the OBBA. And while the headlines focused on the name, sorry, I had to move something out of my way. We're going to talk about how these tax changes affect your income, your retirement, estate planning. So this isn't really a policy update, it's an opportunity for planning. All right, so before we dive in, I want to introduce myself. My name's Kelly Olchak. I am the managing partner of Lindley & Company, and we are 100% woman-owned registered investment advisor based in the Bushels Basin. We manage the finances for a handful of families in the community. And as fiduciaries, we're committed to putting your interests first, even if you don't work with us. I'm also a certified financial planner, which I happily received that designation in 2009. And I am very passionate about helping people turn their financial goals into reality. Let me also introduce Chaz Miller, our incredible operations manager. She'll be our Vanna White today. She's going to keep an eye on the chat function. So if you've got questions, please chime in. Don't hesitate. We'd really love to hear what your questions are. There might be some, there might be none, but I want to make this as interactive as possible. Also joining us is my partner in crime, co-founder Becky Gillette. She's our dedicated chief compliance officer. Very few firms of our size have a full-time CCO focused solely on compliance and operations. We're very fortunate to have Becky watching over our firm. So let's talk a little bit about today's topic. So some of these changes can come with some confusion, questions, sometimes panic, but there's really nothing to panic about on the tax side. We're going to talk about focusing on the things that matter most, and actionable things that you can use to decode everything in the bill. I shouldn't say everything. We're going to focus on things that matter most right now. Let's get a clear idea of where we're moving with confidence. Okay, so we're going to have a couple polls throughout this session to help us stay on track. And Chaz, if you could just launch that first one. Thank you. And you can answer more, you can click more than one of these ideas.
I'll let that go about 10 more seconds, and then I'll end it now because everybody participated. So thank you,
And
everybody.
can people see the results, Chaz? Yeah, good. Is that yes? Okay, that's super helpful. Thanks. Let's move forward. So here are the things we're going to cover today. What changed and why it matters, opportunities, things that are important to retirees, families, and business owners, and what you can do next. So one of the most important outcomes of the new tax law is stability. Up until earlier this year, we were concerned that the 2017 Tax Cuts and Job Act was going to sunset, but now those things like the lower tax bracket, they're now permanent. So as we walk through the slide deck, some of the ideas are permanent, some of the ideas are temporary. So we will cover those as we move forward. So your tax brackets, what this means is there's no tax hike coming in 2026. And that makes our planning for you very easy. And it allows predictability around things like Roth conversions, drawdown strategies, speak Kelly, and charitable gifts. So this slide talks a little bit about the standard deduction. So some people itemize, a lot more people, the majority of people use a standard deduction. And so you'll see that there's a small change, small increase. But for the most part, and 3 of you are closer to retiring the mark, but this is still important for everyone. The big win is an extra bonus deduction. So this is something that the administration was saying there would be no tax on Social Security. There's no way you can do that. However, I should say there's no way you can do that quickly. However, this $6,000 deduction per person over 65 really does help that itemized deduction. So what does this mean? You do not have to be taking Social Security to get this extra new bonus deduction. And this deduction will last from 2025 to 2028. It could be extended. But if you are 65, even if you're not taking Social Security, you will have an additional $6,000 of deduction. And if there are 2 of you, that's $12,000. And that really does help many, many things. It does phase out. So if you're single and you make under $75,000 of income, it will phase out over $75,000. Same with joint, 150,000, anyone making over 150,000, this will phase out for you. So this really does create opportunity to manage tax exposure. Some of you may know what IRMA surcharges are, but if you are in that area, that bracket where you're being hit with IRMA surcharges, and that's Medicare premiums, it will help reduce that. So it'll help prevent that. Oh, and I've got a duplicate there. I like check boxes. So IRMA stands for Income Related Monthly Adjusted Amount. It's an extra premium charged by Medicare if your income is above a certain threshold. And it applies to Part B and Part D. So that's doctor's visits and prescriptions. These surcharges are based on your income from 2 years prior. The more income you report, even from things like Social Security, jeepers, IRA withdrawals or capital gains, the higher your monthly premium can be. So that extra deduction, that $6,000 a person, could really help mitigate some of that. So here's an example. A couple age 67, they report their income of $200,000. But if they qualify, it's going to reduce their deduction. It'll increase their deduction. So maybe that $2,000 will be under the 200,000. I need to start all over today. I apologize. The extra 6,000 for each person could help reduce their earned income and bring that down below the IRMA bracket. And it's a real thing. So if they don't reduce, if they do fall into that IRMA bracket, then, it's $995 additional each person. So that's a real thing. Any questions about this? I have a handout that I intend to share with you about IRMA, so don't panic. I've got some helpful handouts. No questions. We'll move on. So before we get further, let's talk a little bit about what your expectations had been prior to this. So how will this affect you guys?
I'll just give that another 10 seconds or so, and then I'll end it. Thank you, everyone, for
Sure.
participating.
Can you share that?
I will as soon as I end it.
Oh, good. Sorry.
And share.
Cool. All right, next. So this part of the new law brings expanded opportunities for parents, grandparents, and even adult children supporting parents. So the child tax credit is now permanent, and it increased a little bit, and now it's adjusted for inflation, which is very helpful. There's also an adopted child credit, and it's more generous and now partially refundable, making it more accessible for blended or growing families. What does refundable mean? If your total federal tax bill, your tax liability, is less than the full amount of the credit, you can still receive up to $5,000 as a refund, which is very nice. Everybody likes new money. And it does phase out if you have income more than $190. Next, there's the other dependent credit, or ODC. This also is permanent, and it is a non-refundable tax credit of up to $500 per qualifying dependent who do not meet the requirement for child tax credit. So if you have, so it's specifically designed to help taxpayers who financially support people older than that child tax credit age and relationship rules, making it valuable for caregivers for those with multi-generational households. The credit does begin to phase out if your adjusted gross income exceeds $200,000 if you're single, or $400,000 if you are married filing jointly. Now, there's this very interesting new account available that you can fund if you're a grandparent or a parent. This is called the Newborn Tax Deferred Account. These accounts are a new type of tax deferred savings account designed for children, whether they're your grandkids or children. The children have to be born between 2025 and 2028. That's why it's temporary. And they have to have a valid social security number. The government will automatically enroll the child, and the child will receive a one-time $1,000 federal deposit. These accounts allow up to oh my goodness, $5,000 a year in contributions. This is indexed, so it will grow with inflation. And it can no longer be funded after the child turns 18. Contributions can come from parents or others, and employers can contribute up to $2,500 per employee as a non-taxable benefit. Like an IRA, the investments grow tax deferred. Withdrawals are generally prohibited until age 18, at which point the full account balance may be accessed for any purpose. If you're a parent, a grandparent looking to support a child's future, this could be, flexible and impactful. But it's only available from 2025 to 2028. Now, caveat. We really don't know how this is going to work yet, because once the administration creates a tax bill or act, then the IRS has to implement it. So we're a little bit fuzzy on how this is going to work. And we do have a CPA on our webinar today. I don't know when you guys will get tax codes for this from the IRS, but probably by the end of the year. Okay, next poll. Thank you. Glad you're paying attention. Can you say that again, but slower? I will share with you, as we learn more about the newborn accounts, we will send out helpful handouts and any new information on how they're being implemented. Thanks, Chaz. Okay, so this next section is kind of neat. These provisions were defined to offer immediate relief to working households, especially in industries that rely on tipping, shift work, and long hours. So let's cover no tax on tips. Workers in qualified service occupations can deduct up to $25,000 in tip income from their federal taxable income, not state. Only tips that are voluntary, not mandatory service charges, and that are reported to your employer and included in your W-2 or appropriate 1099 for contractors count toward this deduction. It applies only to reported tip income, and there are phase outs for this. So if you make $150,000 and you are a single filer, after 150,000, it will phase out. If you're married filing jointly, that is 300,000, and it must be documented and reported to qualify. So these deductions only reduce your federal income tax. It does not affect Social Security. So you'll pay into it, you'll report these dollars. It will still be counted toward your Social Security and Medicare payroll taxes, which you want to have done, especially for Social Security, because Social Security accounts takes into consideration your best 35 years. And so you don't want to not have those tips counted for sure. And employers will withhold taxes for Social Security and medical or Medicare on all of those tips. So what's a qualified service occupation? In the context of the OBBA, tip and overtime, because we're going to cover overtime next, generally refers to professions where compensation is primarily earned through direct services to customers or clients, especially those who are being tipped by their customers or work hourly. While the OBBA has not released final Treasury definitions, the draft and related guidance suggests the following would likely qualify. So even if you are not in any of these positions, it'd be really awesome for you to share this with people that you know. If you're self-employed, you may still qualify. So like my hairdresser, she's a 1099, but she has to include that those tips in reporting. Okay, so let's talk about overtime. So as it states, this provision is designed to help hourly workers who often put long hours in, especially in industries like healthcare, skilled trade, logistics, hospitality. So if you're someone in your household, if you or someone in your household or even your family earn consistent overtime, this deduction can reduce your taxable income, just like the tips. So it's going to be counted toward federal only, and it will be counted toward your Social Security and Medicare taxes. These are both time sensitive. They only last from 2025 to 2028. Now, we didn't think that the Tax Cuts and Jobs Act would be extended. So this is from 2025 to 2028, but it could be extended. Any questions on this? Okay, here's a neat one. The next neat one. Oh, let me talk about this. Okay, forgot this part. So the premium portion on overtime matters. So if you get 40 hours a week and then you get 60 hours for overtime, the $20, the extra premium is what's deductible, not the 40 plus 20. Any questions? Okay. So here's a really interesting one, auto loan interest deduction. So this is definitely unusual. I don't remember personal auto loan interest ever being deducted. Under this provision, if you're planning to purchase a new car, and again, this goes from 2025 to 2028, if you purchase a new car for personal use and it's assembled in the United States, you may be able to deduct up to 10,000 in interest over the next few years annually. This doesn't apply to leased cars, used cars, or business used cars like fleets. But for individuals and couples planning to buy a new car soon, especially in households under the phase-out limits, which are $100,000 if you're filing single or 200 if you're filing joint, this could be a really big deal. As always, you got to document things. So what I learned doing this is that your VIN number, if your VIN number starts with a 1, 4, or 5, that means your car was assembled in the US. So there are Toyotas and BMWs and Mercedes-Benz that are assembled in the US, so they are included in that. You do want to include the VIN number in your tax return. Okay, next slide. Thanks, Chaz. You want to share that? Thanks for participating, you guys. Okay. So this is a big one in New York State. And now the SALT deduction is permanent. So in order to get this deduction, though, you have to itemize. So the cap used to be $10,000. Now it's as much as $40,000, but only if your income is under $500,000 as a household. That means high income households may still be capped, but many more people are likely to qualify if you itemize. It's especially important if you itemize. Again, this goes from 2025 to 2029. So it does allow for a little longer window there. So what does it include? Your state and local income tax or sales tax, your property tax, mortgage interest, charitable deductions, and certain medical expenses if those expenses are more than your adjusted gross income. So considering this, you may decide to go and itemize after this if it makes sense. And again, we are not giving you tax advice. We are giving you tax planning ideas. And this might be something you'd want to bring up to your tax preparer. One more poll. I bet that's Paul answering that last one. Thanks for participating, guys. Okay, so I'm going to go through this quickly. I don't believe we have any business owners on this, but it's still important. If you have friends that are business owners, the QBI deduction was created to level out the playing field, and it was part of the Tax Cut and Jobs Act that was implemented in 2017. When big corporation tax rates were cut in 2017 from 35% to 21%, small business owners didn't automatically benefit because most of them had pass-through entities like LLCs, partnerships. And so this part of the tax code is now permanent, which is very good for small business owners. To give those small business owners a competitive break, the Congress introduced this, and up to 20% of qualified business income can be deductible or might be deductible from taxable income. So it's a very valuable tool, but it's not available to everyone. So if you're in particular professional fields like financial services, there's no benefit for us. But a lot of other business owners can take advantage of this. And this is where if you think you're eligible and you didn't know about this, if you're a tax owner, business owner, talk to your tax preparer. Okay, so this is not just about your portfolio. It's about your family goals, your legacy, travel plans. Planning isn't about chasing the market, as I've said so many times. It's about building structure around your life so you can help keep moving forward and get those goals accomplished. So I'm going to give you some actionable ideas and handouts. So, because I know I'm covering a lot of stuff, but I've got some really great handouts that you'll receive after the workshop. So to lower your income, lock in those tax brackets, leverage that senior bonus to reduce your IRMA, and consider Roth conversions. So Roth conversions is a very long conversation. If you're interested in discussing it with me, it's certainly a really neat conversation. I can tell you there are a couple people on this workshop that would benefit from that. And I've got a handout that will, two of them, one for the IRMA piece and one for the Roth conversions. It's kind of like a flow chart checklist to kind of get your arms around what these could mean to you. So the next one is taking advantage of the newborn account, using the child independent credits, planning around SALT. So I've got these two guides, especially this understanding your tax return. I found this to be really interesting. When I get my tax return, sorry, Paul, it's just a bunch of numbers. When I used this, it was like, oh, I didn't know that's what that was. So the first one will help you understand how the OBBA affected like 2024 versus 2025 and 2026, and then certainly understanding your tax return. And then for those business owners, understanding how the QBI works and how to maximize your retirement planning to reduce your modified adjusted gross income is super helpful. And so I've got this helpful handout for those of you that are business owners. Additionally, you're going to get these three things. Some of you are in retirement, some of you are not, and key financial data. That is the last, this is the last poll, and I cannot believe I got that done in 23 minutes, even if I can't speak. And Chaz, we're early, so I was wondering if people want to ask questions, we could open up the mic for them if they want to raise their hand after this is done.
Yeah, so there's a little emoji, depending on what you're on, computer or tablet or phone. There is a spot where you can say raise hand. So if anyone does want to chime in and say anything, just let me know. I can allow you to talk. I'm
Cool.
gonna end that and share the last poll. Overwhelming majority is just trying to make sense of everything.
I will tell you, I started working on this workshop in July. I took a 4-day 3-hour course to pull apart all these pieces because it's quite complicated, especially around planning. And as Chaz and Becky will tell you, I'm very excited about the planning opportunities. So we'll stop sharing there. Does anybody have a question? I'd love to hear voices and see if there's anything that you'd like to discuss, maybe things I did not touch on. That would be helpful. Y'all are going to be quiet on me, aren't you? Okay. So that's what we have for today. All of you that are attending right now are clients. If you would like to discuss one-on-one how this applies to you and how you can implement it, or any ideas that you might have around changing your cash flow because of this conversation, I'd love to have one-on-ones with you. And if there are no more questions, then I think we are done. You will get
Thanks,
a
everybody.
survey. You'll get a survey at the end of this. I would love feedback. Sometimes people give me great feedback on things we missed or things that you would like to hear more about. Next month's webinar is going to be about Social Security income strategies for married folks, divorced folks, and widows. And now that we've got these new tax changes, that conversation is going to be including the tax changes. So thank you, everybody.